Welcome to Financial Statements 101. What I want to do is just talk at a fairly high level about the financial statements that you're getting from your accountant every year and hopefully from your accounting team every month. The main statements are the balance sheet, the income statement, and the statement of changes in financial position, or also known as the cash flow statement. Number one, the balance sheet. The balance sheet is a snapshot in time view of what you own, your assets. So these can be tangible things like cash and equipment and land and buildings and receivables. And they can be intangible things such as trademarks, intellectual property, website, and things that are obviously not touchable, but that exist and are very valuable for your business. So that's the asset section. The liabilities is what you owe, and both the assets and the liabilities are set up into the current portion, which you would expect to convert into cash or consume cash in the next year. So most of your inventory, hopefully, you would expect to sell in the next year, so that's considered a current asset. If at the end of the year you have a whole bunch of inventory that you think will never sell, or it's obsolete, or it's damaged, that actually needs to be written off. You need to provide a provision for that to reduce that value, because the things on your balance sheet need to have that value and that expectation of conversion to cash within the next 12 months. The current liabilities portion indicates what will be consumed with cash. So you will be paying your accounts payable, you'll be paying you the short-term debt payments or lease payments within the next 12 months. So the current portion means what's going to happen in the next 12 months. The long-term portion of assets, capital assets, so that's land, buildings, and equipment, things that last much longer than a year. And long-term liabilities means these are your loan payments beyond the next year's portion. So if you have a 5-year or a 15-year loan, it will show the remainder of those. So your balance sheet consists of assets, and that equals liabilities plus equity. And equity is a combination of what you've paid for the shares plus the earnings retained in the business. So the retained earnings is very important, especially if you borrow money and have bankers, because bankers typically lend and by looking at your retained earnings as a foundation for how much debt they're willing to lend to you. So your balance sheet equals assets equals liabilities plus equity, and the equity is in part a value of your company and how much profit you've retained. The income statement. The income statement shows revenues. If your income statement shows all your revenues in one line, you need a better income statement. You should be able to measure product and service revenues by department, by division, by individual product and service that's relevant to you. And the next section should have cost of goods sold for each of those product and service lines, so that you can measure in the next section the gross profit by product and service line. And this is often the first place, the first improvement that many businesses need, because they're not measuring gross profit by product or service line. They don't know which products are most profitable and which ones are least profitable. That's a great place to start. So after you've got that gross profit dollar, you can analyze the percentage as a percentage of total revenue. Then the general and administration expenses, so that includes your overheads, and then if possible structure it so that your interest, taxes, depreciation, and amortization are recorded separately, and that will allow you to calculate not only net income but also EBITDA. And a lot of financing institutions and definitely investors are looking at your EBITDA performance each month. If you're tracking and measuring EBITDA, you're focused on the right thing, because more times than not, EBITDA is used as a valuation tool. So whether it's 1 times EBITDA just to keep the math simple, or in your industry, businesses normally transact at 5 or 8 times EBITDA, you understand the value of your company and connect the income statement to valuation. And that's really important. The third main statement is the statement of changes in financial position. So this shows cash from operations, cash from financing activities such as borrowing, and then cash from investing such as selling shares, paying dividends, things like that. So it gives a fairly high-level look as to where the money is going. More importantly is to look again by your working capital and your days to cash and certain key ratios that these statements tell you, and that will give you a better snapshot of what's actually happening in your business. A lot of people say a picture tells 1,000 words. A good financial statement tells a story of 10,000 words. So you need your accountants to interpret this information and convert the historical information in the financial statements and tell you what the future looks like based on the trends and patterns that exist in your historical financial statements. If you're doing that on a regular basis, I guarantee you'll improve the performance and value of your company. That's Financial Statements 101.